In just a matter of hours, Intel saw its $100 billion market value, well, just evaporate. And it wasn't from a market crash, but from a single silent decision made in Beijing that flipped a switch, transforming the king of chips into, honestly, the most vulnerable pawn in the escalating global tech war. On April 12, 2025, China's Ministry of Industry and Information Technology issued a policy change. One so precise it threatened to unravel America's entire semiconductor empire. Quietly executed, this directive banned government agencies and major state-backed firms from purchasing chips from U.S. manufacturers, including Intel, AMD, and Micron. The reason cited was digital sovereignty and the protection of China's supply chain, a well-aimed strike, you could say, directly at the heart of Silicon Valley's dominance. By the next day, procurement systems were rewritten, and key contracts, including those with China Mobile, State Grid, and Huawei-linked server vendors, were voided. Intel, which, derived nearly 27% of its 2024 revenue, around $22 billion from China, saw its stock plummet by 18.3% within 2 days. This wasn't just a reaction to lost sales. Traders were, in fact, pricing in something far worse: the beginning of a complete Chinese phase-out of U.S. semiconductor supply. But what if this move wasn't about chips at all? What if the target was something far larger, U.S. innovation itself? Beijing's action, while it seemed defensive, was likely a calculated offensive maneuver, one executed with surgical precision. This wasn't just decoupling, it was a deliberate erosion. Emily Jin, a geopolitical analyst at the Center for a New American Security, warned that this strike wasn't just economic, it was an intentional weakening of the very foundation of American tech power. Intel's dependency on Chinese customers made it, well, uniquely vulnerable. While competitors like Nvidia generated just 19% of their revenue from China, Intel was deeply intertwined with China's infrastructure, especially in the PC and server processor markets. The loss of these ties didn't just punish Intel, it created ripples that sent shockwaves through Silicon Valley's most essential corridors. The collapse of Intel's market cap also dragged down major ETFs like SOCX and SMH, causing a 4.2% and 2% dip in semiconductor indices. That day, but really, this collapse wasn't sudden. It had been brewing for years, a consequence of a long series of missteps and compounded failures. Back in 2011, Intel controlled 80% of the global PC processor market. By the fourth quarter of 2024, that share had dwindled to 57%. Years of delays in the 10-nanometer and 7-nanometer chip rollouts gave AMD the room to claw back market share, while Apple and Amazon forged ahead with custom design chips. Financially, the company was already struggling, posting a $2.8 billion loss in the first quarter of 2023, followed by an $8 billion loss in the fourth quarter of 2024. By the time China flipped the switch, Intel had lost its pricing power, its market dominance, and its strategic insulation. Doug O'Neill, a semiconductor policy researcher at RAND, put it bluntly, Intel's business model was still tethered to yesterday's globalization and, well, Beijing had just slammed that door shut. But Beijing's... The move was not merely a defensive play, it was a signal that something bigger was underway. The timing, the precision, all of it pointed to a larger strategy. This wasn't just about retaliating against a chipmaker, it was about preparing for the long game. According to internal documents reviewed by Reuters, China had set a deadline. By December 2027, the country aimed to eliminate all U.S.-sourced semiconductors from its public infrastructure, energy systems, and telecom equipment. The mandate, known as Clean Silicon, required that by the first quarter of 2026, 80% of all central government computing systems must run on domestically produced chips. This wasn't just a loss of market access for Intel, it was the forced obsolescence of American tech inside China, the world's second-largest market. Morgan Stanley now estimates this policy could cost U.S. chipmakers a staggering $350 billion in revenue by the end of 2027. Analysts at J.P. Morgan warned that while the immediate impact was painful, the long-term damage was even more strategic. If China succeeded, it would show the world that the global chip supply chain could survive, perhaps even thrive, without U.S. tech. The precedent would be set for other nations, from Brazil to Indonesia to parts of Europe, to follow suit. Beijing wasn't just executing a ban, it was proving a concept, a new tech stack for a post-American world. The most shocking revelation: Huawei, once thought to be crippled by US sanctions, had quietly been building its own path forward. In September 2024, Tech Insights stunned the tech world when it revealed that Huawei's Mate 70 Pro smartphone was powered by a 5-nanometer Kirin chip, domestically produced by SMIC. Built using older DUV lithography machines, it defied expectations by achieving sub-7 nanometer production without the advanced EUV machines from ASML that the US had assumed were indispensable. This was a game-changer, a signal that China had not only caught up, but was quietly closing the gap. And now, with every move from Beijing, the world was taking notice. From Beijing, it's clear that the global balance of power in tech is shifting. The question is no longer just about chips, it's about the future of innovation itself, and whether the US can hold its ground before the clock runs out. The struggle was far from over. In Ohio, where its semiconductor future was supposed to be forged, Intel was still wrestling with delays, unable to resolve the yield issues plaguing its factory. Meanwhile, Huawei, with none of the tools or resources that the US believed essential, had already overcome the impossible. The 18A node, Intel's next big leap, was still a distant promise, while Huawei's chips were more than just a symbol. They worked, and they sold. In just 6 months, Huawei shipped over 45 million Mate 70 devices. Domestic demand was surging. The supply chain was proving resilient, maturing faster than anyone had anticipated, and honestly, it didn't stop there. In the first quarter of 2025, SMIC's revenue surged by 47%, driven by a surge in state-aligned procurement. On the other side of the world, Intel's data center revenue had plummeted by 22%. The US had bet big on bottlenecking China's access to the tools needed to build its tech future, but China had countered with something far more dangerous, the ability to scale up what they already had and make it work. The results were clear. With Huawei's chip ecosystem now functioning independently, the real barrier wasn't technical, it was time. But this wasn't supposed to happen, not like this. The US had everything, the patents, the global suppliers, the technological superiority. They held all the cards, but somehow Huawei leapfrogged the entire playbook. What started as a bureaucratic roadmap in 2015 had evolved into one of the most audacious industrial transformations the world had ever seen. By the first quarter of 2025, more than 75% of China's strategic sectors, everything from aerospace to telecom to power grids, had transitioned at least partially to domestic semiconductor suppliers. Huawei, SMIC and others were now pulling in upwards of $58 billion annually in state support, while US companies like Intel were increasingly shut out of procurement chains. So Beijing wasn't just racing against the US anymore. They were actually building a parallel ecosystem that, well, didn't need the US at all. The US share of Chinese chip imports had fallen to just 28% in 2024, down from 41% in 2021. Domestic alternatives now commanded more than 55% of government computing contracts. The real question now wasn't whether China could replace US firms, it was when they would stop needing them entirely. But the clock was ticking. Could Intel respond in time or, had that window already closed? The CHIPS and Science Act had unlocked $52.7 billion in federal incentives, with Intel set to receive $8.5 billion in grants and $11 billion in loans. Yet, despite the money flowing in, execution remained painfully slow. Intel's Ohio megafab, dubbed Silicon Heartland, was now expected to start partial operations in late 2026, almost a full year behind schedule, plagued by zoning delays and construction setbacks. Meanwhile, Taiwan's TSMC was on track to begin 3-nanometer production in Arizona by the third quarter of 2025. Intel's deal with Amazon Web Services, valued at $8.2 billion, offered a temporary revenue cushion, but it was just that, a cushion. Analysts at Bernstein warned it wouldn't be enough to offset the $13.7 billion Intel risked losing from China by 2027. Government support could stabilize Intel, but it couldn't accelerate Moore's Law, and it sure as hell couldn't buy back lost time. And the fallout wouldn't just be felt in boardrooms. In 2025 alone, Intel announced layoffs affecting 1,250 employees across its data center and client computing divisions. These cuts followed a sharp 19% decline in first-quarter processor shipments, driven by slumping demand and lost international orders. But the real sting would come in the form of price hikes. OEMs like HP and Dell were planning to raise prices by 12 to 17% on upcoming models powered by Intel chips. Without China absorbing production at scale, Intel faced a painful choice: cut output or raise prices to preserve margins. This wasn't just some abstract supply chain issue anymore. It was about to hit consumers hard. Cloud hosting costs would rise, enterprise server hardware would become more expensive, and AI acceleration units used in everything from healthcare to logistics, well, you guessed it, they'd be repriced too. And this was only the beginning. But even with public funding and price hikes, could Intel recover, or was this just the first stage in a much longer, more painful decline? Intel's future now hung in the balance, a race between capital and relevance. With over $19 billion in CHIPS Act support and strategic deals with AWS and the Department of Defense, Intel had the scaffolding for a comeback. But the markets weren't convinced. Intel's stock had underperformed the semiconductor index by 31% over the past year, and analysts had recently downgraded the company, citing persistent margin compression, missed deadlines, and growing competition from overseas. What's more, Intel's innovation lead was shrinking. The 18A node, Intel's next generation, wouldn't be ready until mid-2026. Meanwhile, Samsung and TSMC were already in production with 3-nanometer chips, and prototypes for 2 nanometers were already ramping up. Former CEO Pat Gelsinger, now in an advisory role, warned that this wasn't about winning a single quarter. It was about, staying relevant over the next decade. But staying in the game meant more than just building factories. It meant regaining the technological credibility Intel had lost. And then there's China. Make no mistake, Intel isn't the only target here. Today it's the headline, but it's not the endgame. China is redefining who gets to play in the global tech race. And it's not about isolating one company. It's about a full-scale export ban on critical technologies. Gallium, rare earths, AI training chips. Basically everything that powers the future of computing. Washington's response is coming, but honestly, it may already be too late. Behind the tech war lies a deeper, more existential question. Can a country that once invented the semiconductor era survive its own dependence on foreign supply chains? The answer may determine the future of global tech as we know it.